Beyond Meat launched one of the most dramatic IPOs in modern food history. In May 2019, the stock priced at $25 surged past $240 within weeks and captured the imagination of investors who believed plant-based protein would disrupt the global meat industry.
Ethan Brown founded the company in 2009 in Los Angeles. His mission was direct: create meat from plants that tasted good enough to replace the real thing and sell it right next to beef in the grocery store meat case.
The first national retail launch came in 2012 at Whole Foods. The Beyond Burger debuted in 2016, positioned in the fresh meat section rather than the frozen vegetarian aisle. A deliberately provocative merchandising choice that defined the brand.
Revenue peaked near $465 million in 2021. Since then, the story has been one of contraction. Consumer enthusiasm for plant-based meat cooled, price premiums held firm against animal protein, and competition from Impossible Foods intensified.
Today, revenue has stabilized near $275 million. The business splits between U.S. retail at 46%, U.S. food service at 21%, and international channels handling the remainder. Each segment faces different competitive pressure.
The economics are the critical challenge. Gross margin is near break-even, a dramatic contrast to conventional packaged food companies that routinely operate at 30 to 50% gross margins. The high cost of pea protein isolation and manufacturing keeps Beyond Meat structurally unprofitable at current volumes.
On the competitive radar, Beyond Meat scores high on brand recognition. It is arguably the most recognized plant-based meat brand in the world. But Tyson Foods and traditional meat producers obliterate it on price competitiveness and distribution scale.
Impossible Foods remains the most direct competitor. Private and well-funded, Impossible has expanded grocery distribution and locked in food service partnerships with Burger King in the United States. The two companies compete for the same shelf space and the same consumer.
The retail and food service distribution network reaches over 100,000 points of sale globally. Despite the revenue decline, product availability is not the constraint. It is consumer willingness to pay a premium for plant-based protein that has softened.
Ethan Brown remains founder and CEO, the position he has held since founding the company in 2009. He holds a degree from the University of Maryland and an MBA from Johns Hopkins. His leadership through the IPO, the peak, and the long decline defines the entire corporate narrative.
Brown has consistently maintained that plant-based meat is a long arc category and that consumer habits take decades to shift. The question the market is asking is whether Beyond Meat has the balance sheet durability to survive long enough to find out.
Debt stands near $500 million against just over $200 million in cash. That liquidity runway and the pace of cash consumption are the most watched metrics for investors trying to gauge whether this is a turnaround story or a terminal decline.
Q1 2026 results are in for Beyond Meat. Whether revenue stabilized, gross margin improved, and cash burn narrowed, the full picture is in our earnings episode. I'm Hudson Thomas for Charged Alpha. Beyond Meat reported Q1 2026 net revenues of $58.2 million, down 15.3% year over year, narrowly below the $59.6 million estimate. The headline is gross margin. The company achieved its first positive gross profit in recent history, $2 million at 3.4%. EPS loss of 10 cents beat the 12-cent estimate. The stock fell 15% post-earnings. This is Charged Alpha. I'm Hudson.
And I'm Lana. Beyond Meat is the pioneer of plant-based meat alternatives, products that mimic beef, pork, and chicken, using plant proteins, primarily peas and mung beans. The company sells through retail, grocery, and food service channels, including quick-service restaurant partnerships. Beyond Meat launched the plant-based meat category with the Beyond Burger in 2016 and remains the most globally recognized brand in the category. Market cap is approximately $1 billion.
Ethan Brown founded Beyond Meat in 2009 with a mission to replace conventional animal proteins with plant-based alternatives matching meat's taste and nutrition. Brown has been CEO through the celebrated 2019 IPO and through the subsequent category collapse that transformed the company from a growth story into a survival turnaround. Cost restructuring, gross margin recovery, and cash preservation now define his entire focus as CEO.
Net revenues of $58.2 million declined 15.3% from $68.7 million in Q1 2025. The decline reflects ongoing consumer pullback from plant-based meat, a trend persisting for multiple years since the peak category excitement of 2020 and 2021. The revenue miss narrowly underperformed the $59.6 million estimate.
The first positive gross profit margin in recent history is the most significant Q1 data point. Gross profit of $2 million at 3.4% was achieved through manufacturing improvements, plant protein cost reductions, and closure of underutilized capacity. Positive gross margin is the fundamental prerequisite for financial recovery. The company had been burning gross profit dollars for multiple consecutive quarters.
Net loss of $28.5 million improved 53% from the $61 million loss in Q1 2025. The improvement reflects the gross margin turnaround and significant operating expense reductions from restructuring. Headcount has been cut substantially from peak levels, and marketing and research expenses reduced aggressively. Operating cash outflow remains significant, but is dramatically lower than prior year rates.
GAAP EPS loss of 10 cents beat the 12-cent estimate. With approximately 290 million shares outstanding, the 10-cent loss implies roughly 28 to 29 million in net loss, consistent with the reported figure. The EPS beat reflects better than expected gross margin performance and lower than expected operating expenses. The adjusted EBITDA loss trajectory is the forward-looking profitability metric analysts track for the recovery story.
The balance sheet is the most critical survival variable. Cash of $205.8 million stands against $411.6 million in total debt, a net debt position with negative shareholder equity. At approximately $25 million per quarter in operating cash outflow, the company has roughly 8 quarters of runway before needing additional capital through debt refinancing, equity issuance, or reaching operational cash flow break-even.
Q2 guidance of 60 to 65 million in revenue implies modest sequential recovery from Q1. If the 62.5 million midpoint is achieved, quarter-over-quarter growth of approximately 7% would represent the first meaningful revenue inflection in Beyond Meat's recent history. Management has not provided full-year guidance, reflecting uncertainty about category trajectory and limited visibility into retail restocking and food service demand trends.
Analyst reaction was cautiously constructive on operations, but sobered by the revenue miss and 15% stock decline. The gross margin inflection to positive 3.4% is the data point analysts waited for. It proves the cost structure can support profitability if revenue stabilizes. The central question: can revenue stabilize before the cash runway forces a restructuring event?
The gross margin recovery is more meaningful than a single quarter's EPS beat. Previous periods showed Beyond Meat losing money on every unit sold after input costs and manufacturing overhead, a structurally unsustainable model. Q1's positive gross margin suggests the company has fundamentally reset its cost structure. Whether this is durable through volume cycles and commodity cost fluctuations is the key operational thesis question.
The 15% post-earnings decline despite the EPS beat reflects the market's focus on revenue trajectory. The revenue miss below the already low $59.6 million estimate, combined with ongoing negative year-over-year trends, reinforces the bear narrative that plant-based meat category demand is structurally declining rather than cyclically soft. The gross margin win wasn't enough to overcome the revenue decline signal.
The cash runway math drives the fundamental investor decision. 8 quarters of runway at current burn rates means a capital event is likely before the end of 2027, unless the company reaches cash flow break-even first. Debt refinancing at current credit quality would be expensive and dilutive. Equity issuance at $1 billion market cap would be significantly dilutive. The math creates urgency around the pace of loss improvement.
Q2 guidance of 60 to 65 million is cautiously encouraging but insufficient to shift the bear narrative. Bulls need to see 2 or 3 consecutive quarters of sequential revenue growth to argue the category has bottomed. 1 quarter of guidance implying modest recovery doesn't yet constitute the durable inflection point that would justify increasing exposure to what remains a highly speculative equity story.
The bull case starts with gross margin, proving the cost structure reset is real. If positive gross margins are maintained through Q2 and Q3, while operating expenses stay disciplined, the path to adjusted EBITDA break-even becomes a credible 18 to 24-month story. Reaching cash flow break-even without raising additional capital has dramatically better odds of survival and recovery.
Category reset could attract renewed retail interest. The plant-based meat category declined sharply but could stabilize at a smaller, sustainable size. BYND Meat, as the most recognized brand, would retain meaningful share of whatever equilibrium emerges. New product innovation, lower cost formulations, new formats could reopen retail shelf space that was reduced during the downturn.
International growth provides a long-duration optionality layer. Beyond Meat has brand recognition outside the U.S. that could be leveraged more aggressively if domestic operations stabilize. International markets are earlier in the plant-based adoption cycle, offering category growth rates unavailable in the more mature and declined U.S. market. Cost-efficient international expansion would extend the total addressable revenue opportunity meaningfully.
The structural demand decline is the primary bear thesis. Plant-based meat adoption peaked in 2020 to 2021 and has declined persistently, not just cyclically corrected. Consumer taste preferences, price premium versus conventional meat, and the processed nature of plant-based products have driven sustained category contraction across multiple years.
The solvency math is the bear's clearest argument. Cash of $206 million against $412 million in debt, with ongoing operating losses, creates a finite survival window. If revenue doesn't reach cash flow break-even within 2 years, the company faces debt restructuring or dilutive equity issuance that would significantly impair equity holders' value.
Retail shelf space losses compound the revenue decline. Grocery retailers reduced Beyond Meat's shelf presence as sell-through rates declined and category excitement faded. Recovering lost shelf space requires retailer conviction about consumer demand, difficult to rebuild after multiple years of declining velocities. Each quarter of additional decline makes the case for shelf expansion harder.
Input cost volatility threatens the gross margin recovery. Pea protein and other plant-based inputs have shown meaningful price fluctuations. The Q1 gross margin of 3.4% depends partly on favorable input cost dynamics. If commodity costs rise in subsequent quarters, gross margin could revert negative, undoing the recovery that is the primary bull argument for the stock.
Impossible Foods remains the primary direct competitor in plant-based burgers, privately held and not directly comparable on financial metrics, but directly competitive on restaurant partnerships and retail shelf space. The head-to-head competition between Beyond Meat and Impossible Foods for food service accounts and grocery positioning is the most relevant competitive dynamic for understanding Beyond Meat's U.S. market share trajectory.
Hain Celestial Group represents the broader natural and organic food category peer, a publicly traded company that has similarly navigated category demand normalization after elevated consumer interest in natural food alternatives. Hain provides a framework for what category normalization looks like for a natural food pioneer in a post-peak demand environment.
Tattooed Chef was an earlier stage plant-based food company providing a cautionary comparison for Beyond Meat's survival trajectory. Tattooed Chef faced similar challenges: post-hype category decline, cost structure pressure, and balance sheet strain. The parallel illustrates difficulty navigating plant-based category contraction without the scale advantages larger food companies have.
On valuation, Beyond Meat at approximately $1 billion implies roughly 4 times trailing revenue on a $58 million quarterly run rate. For a company with declining revenues, negative equity, and meaningful near-term capital risk, this multiple embeds significant optionality value around the gross margin recovery and potential category stabilization. The valuation is speculative and requires meaningful execution improvement to be justified.
Beyond Meat options heading into Q1 showed elevated implied volatility, consistent with the stock's history of large post-earnings moves in both directions. The small market cap and ongoing financial stress make the stock highly reactive to quarterly results. Pre-earnings put buying was substantial, reflecting bear positioning around the revenue trajectory and balance sheet concerns. The 15% post-earnings decline was within the implied move range.
The 15% decline despite the gross margin milestone and EPS beat illustrates the complexity of trading distressed turnaround earnings. Options positioned for gross margin upside found the stock moving against them as the market focused on the revenue miss and ongoing category decline. The revenue trajectory remains the controlling sentiment driver, regardless of cost structure improvements.
Insider activity at Beyond Meat reflects a company in turnaround mode. CEO Ethan Brown has maintained his equity position as the founding chief executive committed to the company's mission. No notable open market buying has been reported to signal near-term conviction, nor unusual selling indicating pessimism beyond normal diversification patterns.
The combined read is bearish cautious. Options correctly anticipated a negative post-earnings move on the revenue miss. Insider behavior reflects mission-driven ownership rather than near-term trading conviction. The gross margin recovery is real, but insufficient to outweigh the ongoing revenue decline and solvency math concerns. The stock remains a high-risk speculative position with binary outcomes around cash flow break-even timing.
Beyond Meat hit a critical operational milestone, first positive gross margin, but revenues continue declining and the balance sheet limits runway. The gross margin recovery proves the cost reset is real. The revenue trajectory must stabilize for the thesis to hold.
Bottom line, solvency risk is the defining variable. Bull case is gross margin plus revenue stabilization reaching cash flow break-even. Bear case is category structural decline, draining the cash runway before break-even. The valuation prices in survival odds that are genuinely uncertain.
Financial data and charts sourced from Financial Modeling Prep. Charged alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh, we do. That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.